Hello, guys. So first of all, I'm super duper excited from our today's guest. So, ladies and gentlemen, without any further ado, Ernest, welcome to the TradePod. I'm super happy and I'm super glad to have you here on our show. So today's topic, we're going to be speaking about options. So recently we have shooted a podcast with one of the great option traders in Israel. That podcast has been recorded in Hebrew, but right now we'll talk about options and about options is in depth in English, so it will be accessible to all parts of the universe. So I'm happy to have you here, Ernest. So first of all, before we'll start diving deep onto all the different topics and everything else, etc., please introduce yourself. Let the audience know who you are.
Thank you very much, Hefek, for the introduction and for having me on your show.
This is
My
our
name
pleasure.
is Ernst Vismans. I'm from the Netherlands, and I started my career, so to say, just over 20 years ago. First, just from home during studies, and then I got into an internship with ABN AMRO in 2007, which was an interesting period, specifically for ABN AMRO, because I joined them, and 1 week after came a very famous letter from a hedge fund that called to break up the bank and split it up and sell it to a consortium of other banks. Now, at that time, I had a spot on the trading floor at headquarters, which was very exciting because there were cameras around every day. And right from the beginning to the end, I went through the whole process there. So indeed, 8 months later, when I left, the bank did got sold, and it ended up in being the biggest banking takeover in history. So that was an interesting start in my career, just a bit of background. After that, I joined a market maker, an options market maker. That was in early 2008, which was again a very interesting time to start in trading because of the start of the crisis. So all of a sudden, I was
2008.
working on a trading floor, and it was an interesting time from a technological point of view, since the firm was making transitions from market making, but manually setting parameters to fully automated options trading. So they were in a development on that side, and on top of that, there were market dynamics, which was absolutely crazy.
I would like to ask you a question now before we proceed. You mentioned that 2008 was a great time to transition between market making, like like leaving your internship into something that will be fully automated trading options. I would like to get you back onto those periods of time, and I would like to ask you. What was the most fascinated event that you remember, like transitioning from market making to options trading, and how you have managed? Because we all know that 2008 wasn't the best time to enter the markets.
Well, the market making, the firm I joined in 2008, they were market makers. They were just market makers in options. Before at ABN AMRO, I wasn't at the market making department. I was in their structured products department, which is a completely different uh, animal, I would say. But I think for market making, so they were the firm I joined. They started market making, and their core business was always going to be market making. The only difference was that before market makers, I mean, in the 80s, 90s, you still had big trading floors, open outcry. That's the way it moved. Then it moved to screen trading, but still, say, setting and updating prices sort of menu with using different sorts of models. So that's what you would do as a market maker, as an options market maker. You constantly first update parameters of your model to adjust prices to say your own options book, so the risks that you have in your on your account. Um, Meanwhile, you would talk to loads of brokers and do large trades with them. Now, this during the time in 2008, they were already in a transition of fully automating that process. So instead of manually adjusting parameters that would sort of determine the behavior of how you send quotes to the exchange, this would be an automated process. And so it was interesting, just not just during the crisis, because all of a sudden the traders that were there were still used to manually setting parameters. They had to deal with the risks, and they just saw different things from what they've seen in many years before. So that was a bit of a challenge. Um, and then there was the technological side of it, because we had to develop uh, the whole system so that we just deal with these sort of risks fully automated.
Mhm.
So,
So actually, when I spoke to that supreme trader here in Israel, he told me, hey, like options trading, especially like in OTC markets, is an experience by itself because if you would like to have if you would like to trade OTC markets, you need to have a prime broker, and the prime broker is a bank basically. So banks are not typical go-to guy for me and you as individuals. It will always remain an option, an open option to large institutions. So what I'm trying to describe to you guys here is that um, when we spoke about how we play with an edge over OTC's markets, especially with options. And that trader had mentioned that um, we need to think of um, how reliable the market is because just banks are moving it from a point to point, and all traders across all around the world that sit for a trading desk behind a bank really drives the price. And there to read where the exotic pair might go is extremely hard. So he mentioned also that automating options and option trading is because of this is a rare market to join. Being or trading with fully automated tools is extremely hard. Is extremely this is not this is not like the go to solution. So you need to think of a really clever way to automate yourself to automate your strategy or to automate yourself basically when you're trading options. So I really understand right now what have caused you to be so fascinated about that transition to option traders with automation. But I would like to ask you, how have you done it? How have you transitioned yourself to fully automated systems? And how have you constructed those fully automated systems? Because options is a challenging surface.
okay, that's a bunch of questions in one big question, I suppose. You touched upon OTC trading, how it fits in, and the difficulty with automating um, options trading in a world that's dominated by big banks who set the market in OTC. That's one thing you mentioned. And then second, how do you transition from automated market making to basically what I do right now, where I do not have the infrastructure that may be necessary to be successful in that area? Is that correct?
Mhm.
Okay. So in options trading, the previous trader you spoke to previously, he is absolutely right. for certain markets. There are definitely a lot of markets, especially in Europe, mostly single stocks options markets, that are dominated by banks, OTC trading. But there are loads of option series all across the world in which the liquidity is really in the screens, so not in the OTC market. And the volumes and the trading is really going on the screen itself, which means even as a retail trader, you can log on, you can see prices, you can trade, you can buy, sell, whatever. And that's where most volume is. So as you can imagine, if that's where the biggest volumes are, um, those markets are less dominated by big banks trading OTC with other banks or market makers. Now
Hmm.
you see this most notably in index options series all over the world. You'll see it in most markets in the United States, and especially new upcoming markets, say the Kospi in South Korea and India, which is hugely up and coming, dominated by retail traders, really, trading in the screen, not OTC.
Really? So just all the countries that you have just mentioned are dominated by retail traders?
Well, in the United States, it's a bit of a mixed bag, obviously, depending on the market, but a lot of liquidity available, and options prices itself, option premium, is not dominated by big banks, really. It's just there's a lot of flow. In Europe,
Yeah.
index options, it's a bit of a mixed bag. Single stock options in Europe all over, massively dominated by banks and OTC trading. But the new and upcoming markets, especially in India and South Korea, big banks, I mean, they have their role, but uh, they don't have the power to shift markets completely. At least that's not what I see.
Hmm. No, obviously, I will tell that, it was, like, speaking about aggressive buyers or sellers, conversely, um, would enable you to see how the liquidity is being taken from retail traders. And those terms that are used today, like even liquidity, isn't really necessary because um, you know, banks are actually dominating the market. But I didn't really know that, that there are markets that retail traders are dominated, extremely dominating the markets.
Especially India is really interesting on this part. They were really up and coming since COVID.
Yeah,
Where I
but
mean,
Indian citizens are not able to trade outside markets.
they are
Only
able
the
to
Indian
trade
ones.
options on India in India. Absolutely. If you look at contract sizes, trading volumes, India is now is has the most amount of options trades in the world almost. I mean, and their notional value is very low because they're all denominated in Indian rupees, and lot size in options is one. So it's fairly cheap for Indian people to trade Indian options, and that's what they do. Also, the Indian exchanges, the NSE and the BSE, they lowered costs of trading, say transaction costs, commissions for Indian options, in order to make it very affordable. So yeah, it's really interesting to
Hmm.
see. So, so it's a bit of a mixed bag, I'm trying to say. Some options dominated by banks, other markets, not so much. Then on the second hand, so you mentioned, okay, so how do you make the shift from market making to what I do specifically? Because
Hmm.
when I left the market maker I worked for, I knew that I was never going to be able to do exactly the same as they do, because I lacked the infrastructure. I do not have sufficient funds to fund the incredibly expensive servers you need close to the exchange to be able to use as fast as possible. Because in automated market making for options, you need to be the fastest. Otherwise, there's no chance. You just end up losing constantly. So I had to do something different. And while I was working as a trader there, I did see um, sort of a different way. I had a different way of looking at options because in this index option series for which I was responsible, I saw certain patterns. I saw certain price behavior reoccurring constantly. Um, Now, and this was not something that the market maker I worked for was much interested in, and rightly so, because they needed to put all their time and attention and resources into automating their systems, not looking at, say, fundamental value of options and see if it makes sense or not. But I did see that sometimes options prices they didn't always make complete sense to me. So
Mhm.
what I did is, okay, let's do some research. So when I left, I started logging options prices for various exchanges, various index options, because that's what I'm most comfortable with for a year, and see what the dynamics are. So does it make sense? And I did find out. So I did find that there were opportunities there, and in sense that sometimes options are overpriced and sometimes they're underpriced. So, and then I designed it into a model, how to recognize whether options are underpriced and overpriced, and then build an automated system that either goes long or short in options in general, and then close the position when prices retract to the levels that make more sense. So that's what I did. So I'm not the fastest. I do not have a market making system, but I do have a model behind it that sort of recognizes when options are either underpriced or overpriced, depending more on statistics, really.
Mhm. So speaking about options trading, let's talk about the core of options. I would like to ask you um about a strategy that you can expose here in relation to option trading, and how do you take advantage over that strategy onto like continuous learning? Because like when you're trading with a trading strategy, you learn and absorb new things each and every single trade that you're actually executing. So I would like to ask you, um, if you would be able to share with us the strategy and how we can learn new things out of it.
So I think the foundation of the strategy is that there is a direct correspondence between prices of options and price movements or volatility in the underlying. So, for example, if you have an index like the Euro stocks, um, if there's a lot of volatility in the Euro stocks, you would expect the underlying option to be more expensive than times when there's very little volatility in the index, um, but the options would be cheaper. And so that's a there's a fundamental relationship between the two. So prices of options and volatility in the underlying. And you can intuitively understand this relationship by looking at options as insurance. You can insure yourself against some sort of move. So in an option, generally there are two different types of options, call options and put options. The call options give a holder the right to buy a certain underlying and a predefined strike price, and the put option gives the holder the right to sell um, the underlying at a predefined price. So say you have an index which is trading at 5,000 and you buy the option to buy the underlying at, I don't know, 5,500, which is 10% higher. Now you can imagine if there's very little movement in the underlying, it doesn't, the option itself is going to be cheaper because the probability that you will actually reach the 5,500 is very low. Conversely, if there's a lot of movement in the underlying, the probability that you will reach the 5,500 is higher, and therefore the price of the option is higher too. Does
Mhm.
that make sense intuitively?
Yeah, yeah, of course, of course.
So
So,
there is a direct correspondence between prices and volatility, and you can capture that.
hmm.
So you can measure it.
So speaking about volatile assets and choosing the right underlying asset, you have mentioned the Euro stock index. Um, and I would like, and you have mentioned one underlying asset. So in terms of underlying assets, I would like to ask you which asset or how do you measure which asset to choose and based on what data or what checklist do you look at when you're choosing the underlying asset? Because those
So the
correspondence could work onto the two ways equally,
yeah,
both
for
good
me,
or bad.
the most determining factor is volumes. So liquidity. I'm going for markets where the highest trading volumes and the tightest bid-ask spread, because ultimately margins are fairly small. Um, so you want to have the cost of trading as low as possible. So
If I would like if I would ask you this, based on the example that you have just shared with us, I would like to ask you this. As a trader, the things as a trader, um, based on those knowledge of correspondence between an index and underlying assets based volatility, um, how would you develop a trading strategy out of it? Like extracting few factors like volatility and underlying assets, or other parts of the strategy that you have just provided us with, and build or construct a real trading strategy that will be able to make you money in the option trading industry.
yeah. So what I do, the way I look at it, I look at prices and I compare it with volatility in the underlying. So there are different methods. So I take prices and you can convert it to a volatility. So for example, um, I won't get too technical, but the price that you see for an option in the market, um, you can fit certain parameters for a very famous options model um, to extract what is called the implied volatility. And what it does is it's sort of um, it's a measure for what traders can expect to see in volatility until expiration of the option. So, for
Mhm.
example, if
Would
we
you
have the
like
euro,
please to explain to the audience what an implied volatility really means?
yeah. So, say you have a call option, and
Mhm.
let's go back one step further. So we have the euro stocks, maybe trading at 5,000. Now let's have a look at the option that gives the holder the right to buy the index at 5,000. So it means there's no intrinsic value, but there is time value. So let's say it expires in a month from now. Now, what's the price? Could be €100, could be 200, could be 500. This is the price that you can trade in the market. And from the price, you can expect, okay, so there's time value, maybe €200. Using this model, that's called the Black-Scholes model, you can expect, you can fit the parameter, the volatility, which is an input parameter for the model, to see what the market implies in volatility.
Mhm.
And so and that's a direct one-to-one relationship for problems.
Yeah. So yeah, going back onto to our discussion about how do you construct a strategy. I really got curious about like um like about the strategy that you were about to construct. So if we were buying 50,000 call options, and I will tell you, yeah, right now we have bought that amount of of call options. So how would you manage a trade based on market sentiment
Yeah. So
using the
basically what I
strategy,
do,
of
I
course?
look at prices and I calculate the implied volatility and say the volatility is 16, which means that annualized, you'd expect to see at the end of the year, the index would be up with its long-term average, plus or minus 16% in a one sigma event. Now, then I compare this, so that's expected by options traders, more or less. I compare this value, this volatility 16, with historical price movements from just before. And then I take the ratio between the two. So for example, if traders expect a volatility, maybe 2% today, because that's something you can imply from options prices. If today or yesterday there's very little movement in the market, then the ratio between the two will be very high.
Hmm.
If, on the other hand, in the last few days or last week, we've seen we've seen a lot of movement, so lots of volatility in the underlying, but prices of options are relatively low, then I have to ask myself, does that make sense? So what I do by looking at lots of options prices in the past, I calculate what market participant options traders expect in volatility, and I compare it for each moment in time what the realized volatility was in the underlying just before, and I compare the two. So what you will see is that usually they go hand in hand because and the underlying assumption is, or the underlying dynamics is that if, volatility, there's a correlation between the two.
Hmm.
So if we've seen a lot of volatility yesterday, then it's likely that we see a lot of volatility today. If for a long period of time there was no volatility at all, then it's likely that for some time in the future, we're also going to expect to see very little volatility. So that's the basis of the strategy. So if these two are out of sync, then there's something interesting going on. So for example, we have seen very little movement in the past, but options prices indicated they expect to see a lot of volatility. Now, to me, that's an indication that maybe options prices are too expensive. Conversely, if we've seen a lot of volatility in the past or relatively high, but options prices do not reflect this, so options prices are very cheap, then that's an indication for me that maybe they're underpriced and maybe I should buy. So that's the underlying dynamic, really. And this is something that you can measure. So, for example, for the past 12 years, I've been storing options prices every 5 minutes for a number of exchanges. I looked at what do market participants expect constantly, and how does that compare to the realized volatility in the underlying just before. And then you can sort of see patterns. Okay, if this is what's expected, fairly high, and this is fairly low. Okay, on average, they're overpriced. So now is the time to sell.
Hmm. I get it. So now, if we're speaking about managing your own trading and what do you do in certain times or certain occasions where you have a strong indication from, you know, uh uh the sigma of of like there will be some volatility within the market in a few couple of days. I would like to ask you, and I would like to speak about like more mathematical, more technical things in relation to option trading. So there are there are a couple of products that I would like to discuss with you that provides you with a with a delta. So I would like to ask you what a delta means and how would you take advantage over the delta within your trading?
Okay, so the delta is just it's a risk measure. It tells you how much the price of the option goes up or down if the underlying goes up or down. So, for example, um, what do you expect to see an increase in value in percentage if say, let's go back to Euro stocks trading at 5,000. So what do you expect to see price increase for a certain option if it goes up 1% to 5,050?
Hmm.
Um, and so the delta is a risk measure. I mean, it's especially market makers, they use this delta to hedge the exposure against the underlying constantly. So what
Hmm.
they do if they buy a call and it's got a delta of 50, which means ultimately there is a 50% chance that the option will end up in the money. It will actually start paying at expiration. They will sell the underlying futures against it so that they're hedged because market makers do not want to have exposure to delta.
Hmm.
So retail traders or hedgers, they look at it differently because I don't know, insurance companies, which uh, they have a huge portfolio of shares and they want to protect themselves against big sudden drops in the market. That's the insurance. So they buy a put with a very low delta. So they actually want is a delta exposure. Market makers are winners who are on the other side, they're short. They do not want this delta. So they'll start trading futures against it constantly or shares. And there you see there's this is what's interesting about the options markets. You have different players with different objectives in the market, where some people actually trade options because they specifically want the delta, and others do not. And I think I listened to one of your podcasts before, and I think there was one trader who said that ultimately trading is a zero-sum game, and that's true for most markets. But with options markets, it's a little bit more subtle, and the delta in here takes has a place in that because some people want delta exposure. That's their objective of trading options, and others specifically do not. They are more interested in, say, I mean, a market maker just trading, buying, selling constantly, and catching a spread. And others are more interested in okay, like what I do, what's the fundamental value of the option? How does it compare to volatility and the underlying, and how do we manage risk there? So, is that something you were looking for?
Hmm. I would love to.
Yeah. Okay. To be a bit more technical, the delta changes constantly as well. So if I buy a call option and I'm a market maker, at the time when I buy, I'm exposed to the delta, meaning if the underlying index goes up, the price of the option also goes up, and it goes up with the delta. Now, as a market maker, I don't want this risk, so I sell a few futures against that position in order that for a small movement, uh, the ultimate P&L on my book is zero. So on the one hand, index goes up, the value of the call goes up, which is good. But then the position against it, the short, sort of negates the movement of price in the call. Now, the thing is, if the price starts moving up more and more and more, the delta changes. So let's go back, say we have Euro stocks trading at 5,000. The 5,000 call, which gives the holder the right to buy call at 5,000, there's a
Hmm.
50% chance that it ends up in the money, which means if the underlying index goes up with 10 points, then maybe the call goes up, the value of the call goes up with €5.
So,
Now,
yeah.
if it does go up further,
Hmm.
um, then the probability that it ends up in the money increases. So all of a sudden, the delta is not 50 anymore, but goes up maybe to 70, 75, 80,
Yeah,
whatever, it goes
it's
up.
increasing.
And the problem then is all of a sudden you are not hedged anymore because you only sold 50 futures against it when you set up the trade in order to be delta neutral. So price impact has no impact at all. If the price starts increasing further, then you start to build up exposure because the probability that the call will end up in the money increases, and therefore the price sensitivity with respect to the underlying increases as well. So we set up the call at
Mhm.
when the underlying index was trading at 5,000, and now it goes up to 5,500, which means that the call set up initially, that it ends up higher at 5,000, the index, is much higher. So you're exposed. So what do you do as a market maker? Since you're exposed, you sell more. So what do we do? Price of the index. We sell first, we buy a call, we sell some futures against it, we're delta neutral, and now market starts moving. It starts going up and up and up and up. At some point in time, the position is too risky because the price sensitivity is too high. So you
Hmm.
sell, and in order to be delta neutral again in your position.
Yeah.
Now, flash forward, say the index goes down again, which all of a sudden, which
Yeah.
decreases the probability
Conversely.
that the call will end up in the money. And now all of a sudden you're short because you did sell more when the price of the index was higher. So what do? You buy back. You
Hmm.
buy back the further
Yeah.
product.
Simply.
Simply. And the funny
Actually,
thing is,
you've put it in a way that really enables will enable you to understand what a market maker way of thinking actually works. And so I
it,
really get fascinated about it. So I would like to ask you a different question about portfolio managing. So as after that we spoke about so many different topics, I would like to make it to narrow the conversation. So um how would you manage your tradings?
my trades.
Yeah, would you use to manage your trades?
So what I do now, as a market maker, or what I do now, you mean?
What do you do now? Because market makers,
Yeah.
it's simple. After your detailed description, it's easy to think about how they manage money. But you know what? Let's let's stick to market makers. Let's make that conversation entirely about market makers. So how do market makers hedge their how do they manage your risk within within their trade, and how do they hedge their positions over time? So this is a part of their trading style.
So managing delta risk is a big part of it. And that can be automated. So you can either trade futures against it, or you can trade other options. So for example, if you buy a call, you can sell some shares on some futures against it, or you can buy the put, or you can sell a call somewhere else in
Hmm.
order to get rid of the delta risk.
This is
That,
how hedging works, guys.
that's how
This is
hedging works.
exactly how hedging works.
Yes, exactly. So, and with market making, but if so, you can buy calls and then you can set up the system. Okay, if I buy a call, I buy a put as well, for example. But if you constantly keep buying calls and keep buying puts, it means that you may be delta neutral, but you have a different type of risk because you are exposed to, say, price drops of the time value part in options. So that's a risk because ultimately you're paying a premium, and this premium, the value of the premium goes down and down and down until expiration. So that's a problem. So maybe if you have bought some options, you're long in options, which is called gamma or vega, depending on the expiry, then you want to sell similar options against it to offset the risk. So what do you do as a market maker if you see the system, how it's calibrated? If your system is buying options, either calls or puts, it adjusts the prices to give other market participants an incentive to buy from you.
Hmm.
So what do? Your system, someone sells some options, which means that I'm now long as a market maker. I want to give other people an incentive to help me out of my position. So I lower the prices. So on the one hand, at initial, when somebody trades against me, I have an initial profit. However, I will instantly adjust my prices against my position constantly
Hmm.
to give other participants an incentive to help me out.
Speaking about gamma and vega, can you please explain us about what are those factors and how do we take them under our advantage when we're trading options?
So the gamma and the vega are, um, I like to see vega as the sum of gamma. And gamma is really, so we briefly touched upon how uncertain dynamics around delta, meaning if I buy a call right now and I sell some shares or some futures against it, and now price start moving again, you build the exposure changes. So buy a call, price goes up, probability that the option ends up in the money goes up. So all of a sudden I'm exposed. So the change in delta over time, that's reflected by gamma.
Hmm.
So if you have a book with a lot of gamma, you can expect your delta exposure to change constantly, very quickly as markets start moving. Now, the only way you can hedge against your gamma is by selling options.
Hmm.
So you can be delta flat, but it doesn't mean you're gamma flat. Um, Now I like to think about, I mean, ultimately, I like to think, okay, what's the theoretical price of an option? And the theoretical price of an option, the way I like to look at it, is that, you touch upon the dynamics. So price goes up, I sell some more shares because I'm suddenly exposed again. Price goes down, I buy it back, and then you really lock in a profit. So again,
Hmm.
we bought a call, we sold some shares against it. The underlying price goes up, which means I'm exposed. How do I get delta flat? I sell some more futures or some more shares against it. Then take the situation where the price of the underlying goes down. All of a sudden I'm short, so I have to buy it back. And so if the price starts of the underlying starts moving constantly, you constantly by nature be buying high or selling high and buying at a low price and locking in profits every single time.
Hmm.
And that's what gamma does. Really. That's hedging your gamma. If you're
Hmm.
buying options, either calls or puts, at any point in time, you'll be constantly, just by dynamically hedging your exposure, you'll be constantly locking in profits. Now, if you do this for a month, I don't know, you buy an option with an expiration in a month from now, and you're constantly, just by hedging your exposure, you're buying high, selling high, buying low, you're locking in a profit. So theoretically, the price of the option, the premium that you pay right now, should equal the net present value of selling high and buying low of the underlying, just to be able to hedge your exposure. And
Hmm.
it's really like that.
Sounds awesome. Sounds awesome. So first of all, I would have to say to you, Ernest, that I'm looking at you like people won't be able to do it because it's an audio experience, that episode in particular. Um, but I look at you for about 50 minutes and I we're speaking about options and I see how passionate you are about that, about the field of options and market and options in particular, about the market and options in particular. So it really makes me fascinated about to learn more and to absorb more and more out of your wisdom and out of your experience that you have embraced over the years. So I would like to thank you. And I would like to thank for your participants within our show, the Trade Pod. And hopefully, this podcast, this particular episode, will influence people to think of how the market maker think and to evaluate their trading skills in a way that will really enable them to be much more wise in the way that they're trading. So I would like to thank you. And it was a pleasure having you here.
Thank you so much for having me. I hope it's been insightful. It's a bit of a complex topic, I
Yeah,
suppose. But
it is a
I hope
complex
I've been
topic.
able to
You did it.
uh,
You done well. You done well. I'm surprised.
it's a bit, I mean, ultimately what I do is slightly different because I'm not a market maker anymore. So I really look at fundamental price of options and I compare it with volatility and then I see, does it make sense? So,
Mhm.
um, and then I automate it. So that's one thing I have in common. Everything is automated.
Simple. Simple, guys.
Painful.
All
Yeah.
right, mate. Thank you. I appreciate it.
Thank you so much for having me, Afek.
Thank you.